Welcome to today's review of the True Potential portfolios and financial markets. My name is Paul Durrans and I'm an investment analyst at True Potential. I'm also delighted to be joined by our investment director, Barney Hawkins.
Hello.
Barney is the fund manager of the True Potential Growth Aligned Funds, and we're both part of the team that manages the True Potential portfolios. So Barney, 1 month on from our last video, what's changed of the month?
Well, we've seen mixed returns from both equities and bonds. The US market has been the best performing market, up more than 4% over the month, building on the strong returns which we've seen over the past year. US businesses have been reporting their latest set of accounts, which have been impressive. Results in the first quarter were excellent, but the second quarter has been even better, with 80% of companies reporting better than expected profits. Loose monetary conditions and the recent tax cuts have energized the US economy, and we expect this effect to continue for the rest of the year.
So the policies adopted by the Federal Reserve and Donald Trump have been positive for US markets, and this year we've seen central banks tightening monetary policy. In the UK, the Bank of England have raised interest rates by 0.25%, and in the US, the Federal Reserve has raised interest rates twice this year and 2 more expected before the year end. Is there a concern that the Fed may choke off excellent growth we've seen in the US too soon?
The Fed has been fairly transparent with its interest rate guidance, and if the so-called dot plot graphs are to be believed, financial conditions are likely to tighten further in response to the robust levels of growth we're seeing. The Fed has to tread a very fine line in setting interest rates at an appropriate level for the state of the economy. If rates are increased too slowly, it may lead to inflation, which increases the cost of living for individuals. Alternatively, if rates rise too quickly, the economy could weaken and inflation could run below the 2% target level, which is set to help achieve maximum employment and price stability. It's a difficult task, but so far the markets have been comfortable with the approach the Fed has taken.
Looking at currencies, the dollar has strengthened this month by 1.3% against sterling and has maintained its trend that we've seen for the last 5 months. Do you view this as a strong dollar or weak pound? And how do currency movements affect the portfolios?
It's a bit of both. The strength of the US economy, the tax reforms that both increased consumer spending and allowed the repatriation of large sums of cash that were previously held offshore by corporate America, they've both strengthened the dollar. The continued rise of the US stock market and of course the rise in interest rates have all helped propel the dollar higher against a basket of international currencies. At the same time, sterling has been undermined by the whole Brexit issue. Speculation continues to surround the terms under which the UK will formally exit the European Union in March next year. What will happen with Brexit is unknown, but throughout this process the uncertainty has manifested itself in the currency markets, with sterling selling off immediately after the referendum result. It recovered earlier this year and then has been selling off again and is currently about 128 against the dollar. Against historical values, sterling appears cheap, but we could still see some short-term weakness as we head towards March. Within the portfolios, we deploy several different currency strategies through the managers we use. Some fully hedge their position, some only half hedge their equity exposure. Others don't make any currency calls at all. So having various strategies helps us with diversification and is designed to stop us becoming too exposed to the effects that currencies can have. Of course, we've benefited at times from currency weakness. Holding foreign assets provides a windfall when sterling depreciates. Also, large UK international stocks which have overseas earnings receive an uplift when these are converted back to sterling.
Moving on to an area that's been grabbing most of the headlines over the month is emerging markets. Turkey, Argentina, and in particular Venezuela have seen their currencies collapse. How much of a concern is this for emerging markets, and can you see this problem escalating?
Turkey, Venezuela, Argentina do all have their own individual problems, but we've been discussing this issue with our fund manager partners, And at the moment, there's no sign of the contagion developing or spreading to other developing economies in a way that we've seen in previous episodes. Rising US interest rates, the strength of the dollar, and country-specific political pressures have all weighed on returns, with some of our managers reducing exposure to the region in favour of developed markets. There's a need to be selective at a stock, sector or country level, which we see in our funds. That said, at our last rebalancing meeting, we reduced our exposure to certain funds which were maintaining a disproportionately high exposure to emerging markets at the more aggressive end of the scale.
So we've trimmed a bit of our exposure to emerging markets, leaving the true potential balanced portfolio with just over 6% in emerging market stocks. We remain aware of the risks and challenges facing the region, but are happy to have some selective exposure given the diversification it offers and the attractive valuation and growth opportunities the asset class provides. Turning to fixed interest markets, where nearly all bonds have fallen over the month, with the higher risk emerging market debt and global higher yield performing worse. So why hold bonds?
It's true to say we remain much more positive on equities given continued economic growth around the world, the raising of interest rates in the US and UK, and tighter monetary conditions generally in Europe. However, diversification across asset classes remains key as the economic cycle matures, and bonds have a key role to play both in risk mitigation and income generation for our income portfolios.
Looking at the portfolios over the month, I see we've been adding to the new True Potential Growth Aligned Fund in both the managed and plus portfolios. What are the reasons for this, and can you give a bit of colour on how the funds have been positioned, but also importantly how they've been performing?
It's early days for the Growth Aligned Fund range, but they're performing well. In the UK, we've placed a greater emphasis on the domestically orientated mid-cap stocks rather than the more currency-sensitive blue chips. We've been overweight the US and particularly in US smaller companies, which has also served us well. We've been reducing our exposure to emerging markets, which are coming under pressure from rising US interest rates and a stronger dollar. And we've also been trimming Europe slightly as we watch what happens in Italy. We've retained an overweight position in short-dated bonds, which has helped keep risk down, and the low-cost charging structure of the fund means we've been able to add performance while reducing the overall cost of the portfolios.
In terms of our managers that we've been overweight, the likes of UBS, SEI and Close Brothers, have these been the right calls?
Absolutely. Close Brothers have had a very good month. They invest in direct equities, and Rita, who manages the fund, hasn't been afraid to run some of her American stocks, which have done very well. UBS has also been strong. Their asset allocation has been spot on, with a large overweight to the US. The currency fund element of the UBS fund always has the potential to be volatile in the short term, but it's a valuable diversifier and has a very good track record. SEI again has got its positioning right, overweight the US and underweight emerging markets.
So we've discussed markets and touched on the true potential portfolios. Can markets continue to perform well despite central banks tightening and geopolitical risks and trade wars remaining?
There's no doubt volatility is likely to persist as rising interest rates and any escalation of the trade wars exposes weakness in economic models. Geopolitical tensions too always have the potential to unsettle markets. However, let's not forget the global economy is continuing to grow robustly, and while interest rates are going up, they're rising only very gradually and are likely to peak far below levels seen in previous economic cycles. The currency fluctuations we've seen, particularly among certain emerging markets, are part and parcel of a normal economic cycle and will present very attractive opportunities in due course. Investing is a long-term game, and any short-term pullback in markets will be taken as an opportunity to buy selected assets. The benefit of the multi-asset advanced diversification approach is that our clients' investments are spread across a multitude of different assets, industries, regions and investment styles, with our managers always able to allocate funds to the most attractive areas at any particular time.
Okay, thank you, Barney. And that's everything from us today. Thank you for listening, and we'll speak to you next time.
Cheerio.